Hello and welcome back to the channel. My name is Zach Collins and this is Financial Education. Today we'll be going through different mortgage types and structures and the differences in how the different products affect tax. So starting off, let's have a look at the difference between fixed and variable rate mortgages. The name of them should give away most of everything you need to know, but fixed mortgages are where the interest rate on a loan is fixed throughout the whole period, whereas variable rate mortgages means the loan can change at any point in time. So variable mortgages are the most common type of loan in Australia, making up about 70% of the Australian mortgage market. If you look at the US, mortgage market, you see it's the opposite. The most common type of mortgage for them is fixed with only about 5% variable. So why is that? There are a few fundamental reasons for this big difference, and I'll go through them now. So I'll start with why fixed rate mortgages are very common in the US, and then we'll relate that back to us here in Australia. So why are they so popular? I'm just going to preface this and say I'm not an expert on their market, but based on my limited knowledge, there's a few reasons which I'll go into. The first reason is because you're able to fix your mortgage for 30 years. This is critical to their popularity. If you know exactly how much your mortgage is going to cost you, and it's going to be the same each year for the life of the loan, you have the security and stability to focus on the other aspects of your life, knowing you're not going to suddenly end up with a massive mortgage payment change. The second reason they're so popular is because it's easy for them to refinance that 30-year loan. If the interest rate drops, they're able to refinance the loan to a lower interest rate and save money each year. Conversely, if the interest rate rises, they don't have to worry about increased costs because it's fixed. So it's essentially a win-win for all mortgage holders. The fact that Americans are even able to get a 30-year fixed rate is itself, it's not normal when you look across the globe. I found this great graph from 2021 from the OECD, which shows that the majority of lending is variable. The next most common is probably the 0 to 5 years fixed, and the amount fixed longer than 10 years is really small. In Australia, the longest you can fix your home loan is 5 years, and I'll get into that a bit later. But the reason they can fix it for so long is because the banks aren't the ones that actually hold and own the loan. There are government institutions called Freddie Mac and Fannie Mae, and these institutions buy up loans from the banks, pass them all up, and sell them off to pension funds and institutional investors. Do you remember the GFC back in 2008? There was a great movie on it called The Big Short, and they explained derivatives a lot better than I ever could. But what was happening is that these loans, they were being bundled together and given ratings. So people then place bets on whether the value of these bundles of mortgages would go up or down. And when everyone defaulted, it basically caused a massive global chaos. Anyway, so that's what still happens today, but at a lower, more controlled level. Pension funds are buying these loans and they're also betting on them. And because the banks don't own the mortgages, even though they may write them, and because Freddie Mac and Fannie Mae, they're also insuring them, they are offering 30-year fixed terms. I don't want to slander the US mortgage market too much, but I believe our system is a lot better, and I'll go into a bit further detail now. So as I alluded to earlier, when you take a mortgage out with a bank or a lender, they own that mortgage, and they can't just sell it off. Because they can't sell it off, they tend to be a lot more stricter with who they will loan money to, and also how much. So if you were lending money to someone, you would want to guarantee that you'll get your money back. You also want to earn a return, and you also want the capital returned. So whereas if you were to sell this loan to someone else, they're the ones taking on that risk. So you don't really care too much about what actually happened to that loan. Because our banks are the ones that need to hold them to the loans, they are also the ones needing to provide that funding. Now, banks make a lot of profit, and they also have a lot of money on hand, but they don't have enough for the demand for mortgages. So where do they get this money from? Some of it comes from the deposits. So if you have a bank account with a bank, they're paying you an interest rate to keep that money with them. What they do is they might lend that money out to someone else and get a return on that, and they're then paying you a portion of that return. We're not great savers here in Australia, so as a nation, our debts they're much higher than our savings, which means the banks need to get funding from elsewhere. And where do they get it from? They get it from the overseas money market. Now, these money markets are generally affected by the cost of money globally and also has a fixed term, which is why the longest period you can fix it is for 5 years, because the bank will then need to refinance that loan they took to give to us. So you can refix your loan after that fixed period ends, but this will be at the market rate at that point in time. So this may or may not be the same rate you fixed at initially. One of the reasons that variable rates are more popular here in Australia is they tend to be cheaper. If the variable rate is, say, 5% as an example, a 1 year fix tends to be about 5.5 to 6%. As you look at longer periods, say 3 to 5 years, you'll find a pattern. So the fixed rate is lower for the longer time frame horizon than a 1 year. It means that they expect the RBA cash rate to drop over the medium term. If, however, the rate is higher, and this is actually more normal, they expect the RBA cash rate to rise. Now, this video is already starting to get a little bit long, so I won't go too into the RBA and the cash rate here. I'll save that for another video, but just understand that they're linked. The interest rate on a fixed rate mortgage is highly dependent on the rate the banks can get from overseas loans and also on their predictions on where the cash rate will go in the near term. Variable interest rates, however, are purely dependent on the RBA cash rate and something called the NIM, or net interest margin. Again, this is something for a different video, but the NIM is the spread between what it costs the bank to procure those funds and the interest rate that they're charging customers. So the RBA used to meet about 11 months of each year. However, from February 24, they changed that to 8 times a year. Now, each time the RBA changes the cash rate, banks will generally increase their variable loan rates in line with that increase. They may do a bit more or a bit less, but generally it's a one-to-one increase. They don't, however, need to decrease it. If the RBA lowers the cash rate, they might match it, they might not. It'll depend on, how they want to run the bank and whether their main competitors are doing the same. Now, that's enough about that. So let's get on to redraw and offset. Now, these two are very similar things, but they're also very different. And the ways you use it can make a big difference to the tax effect if you change the loan purpose. So what is redraw? Redraw is where you have a loan account, let's say $100,000. Each month you need to pay $1,000, but instead of paying $1,000, you pay $2,000. This means you're paying it down twice as fast. And each month you'll have a redraw amount growing by $1,000 each month. It's called redraw because you can draw that money back out of the loan in the future if you want. Why would you pay into the loan? When you do that, you're reducing the value of the loan by that amount. Essentially, the whole amount is paying down the principal of the loan. If it's a $100,000 loan and charging you 6% interest rate, that's $6,000 of interest per year. However, if you pay an extra $1,000, it means the principal is now down to $99,000, and you're only paying $5,940 in interest, saving you about $60 each year in interest expenses. Now, $60 a year doesn't sound like a lot, but that's with a $1,000 redraw on a $100,000 mortgage. It would become a massive amount of savings if you were to put more in and the loan was higher and on a 30-year timescale. An offset account is very similar to this, except you don't directly pay down the mortgage. If you have an offset, it means that every dollar in a different account will offset the mortgage in the same way that paying into redraw would. So the biggest difference is that and this needs to be emphasized here, is that whose money it is. When you have an offset account, that money is classed as yours. You can do whatever you want with it. While it's in the account, it lowers your interest expense, but you can control it as you like. Redraw is different. So you've paid down the loan, you've given the money to the bank, and that money is now the bank's. They're letting you pull it back out, but that amount you're pulling out is treated as a separate loan for tax purposes. Let's say you have a $100,000 loan for your home. You pay in $1,000 and that's in the redraw. You could pull that out, but because it's the bank's money, it's then treated as a separate loan. So the total loan is $100,000, but let's say you go use that $1,000 and you go buy a car. So a car is a personal use item and it's completely unrelated to the house. So this would then make it a contaminated loan. 99% of that loan is the home, 1% is the car. In the future, if you ever turn the property into an investment property, you might have a $100,000 loan. However, only 99% of the interest incurred on that loan is deductible. That's because you used the redraw to buy the car in an earlier year. It's completely unrelated to the home and unrelated to the investment. So this portion is not deductible. Because an offset is treated like your money, it does not affect the deductibility of that loan for tax purposes. Now, this is the opposite of debt recycling, which I did a video on last year. Using money from an offset account is not deductible, but buying an asset using redraw from a personal place of residence would be. you're taking two sides of the same coin. Hopefully, I've been able to give you a better understanding, of the differences between a fixed and variable rate mortgages, as well as the differences between redraw and offset. If you guys have any more questions, please feel free to drop a comment below, and I will answer if I can. Thank you so much for watching, and I'll see you guys in the next one.